It's very nice to welcome you all here in Warsaw offices of PGE. Thank you for coming to discuss with us second quarter results. The presentation and the results will be presented by the management team, Mr. Marek Woszczyk, President of the Board and CEO, and Magda Bartoś, CFO. My name is Jakub Frejlich, I'm the Head of Investor Relations. Our speakers today will give the presentation and we'll be ready to address your questions afterwards. Now I will hand over to Mr. Marek Woszczyk. The floor is yours.
Grupa. Good morning, everybody. As always, at first I will present a snapshot of most important data and figures from the second quarter. And of course, we will comment on recent developments as well as give you a rationale, what drove our decisions when we performed the latest impairment tests. Later I will tell you about the progress on our the most important investments, and afterwards, as always, I will hand over to Magda Bartoś, our CFO. She will let you know about the more detailed information on our financials and operations. And as Kuba has said, at the end of our presentation of our meeting, we'll be ready to answer your questions. So let's get it started. Yes, I assumed well that behind me there is a honeycomb presenting the most important figures about the PGE. So the PGE, as you may see, PGE consolidated EBITDA amounted to, thank you Magda, amounted to 2.1 billion zloty, and recurring EBITDA result for the first quarter was 1.7 billion zloty, which is at the same level as the net cash from the operations, almost the same level. So net profit to equity adjusted by impairments amounted to 1.1 billion. And we believe that this was a relatively healthy quarter, reaching the cash generation. In terms of the physical values, net generation was equal to last year half-year volumes, of course, and amounted to 13.1 terawatt-hours. Volumes of the distribution increased a little bit and reached 8 terawatt-hours, with sales of electricity to end customers at the level of 9.4 terawatt-hours. Magda will tell you, give you more light on those numbers. But now I'd like to concentrate more on business environment issues and management's view on the market shape and main drivers of it. So first, we see that the business environment is becoming tougher and tougher, and we are all witnessing worldwide, let me call it, deterioration of the fossil fuel markets. So the trend for almost all commodities is negative. That is also visible on the Polish market. What is bringing another adverse effect is that conventional generation is being crowded out from the merit order more and more by zero or close to zero cost renewable sources, which are additionally supported, but you know that fact. On top of that, we are seeing development of more stringent environmental policies on European level. This is particularly due to preparations to the December summit on climate issues that is to be held in Paris. If we all put that together, that made us as a management team to review our assumptions about the electricity prices forecasts. As a result of the analysis, we decided to revise our assumptions, which led us to review value of our tangible assets with a negative impact of almost 9 billion pre-tax, as we reported already. This impairment, of course, had a pure non-cash effect on our results. That's why we decided in order to stay a kind of a dividend policy a dividend company, sorry for that. We decided to change the dividend policy and allow our shareholders to benefit from still company's good performance. I mean, we're still able to generate enough cash to pay the dividend for our shareholders. In longer term perspective, we have started a review of the strategy, which I will discuss a little bit later. So in terms of the dividend, as I briefly described, the management board, in response to the shifting business environment resulting in recent asset impairment, decided to modify the future dividend policy. So the basis for the computation of the next dividends will be adjusted by impairments of assets. So we maintain the threshold of our recommendation between 40 and 50% of the respective results, which is still net consolidated profit adjusted by impairments. Of course, each year the current situation of the company will be assessed, including its financial standing and some capex needs. And then, upon that, we will give our recommendations to the shareholders in terms of the dividend. But as I say, I'd like to emphasize that very clearly. We want to stay a dividend company. This has been at least two most important factors that led us to change the dividend policy and declare a continuation of staying the dividend company. As I said already, this is a healthy cash generation. We stay able to generate the cash and still strong balance sheet. So we are one of the least leveraged utilities across Europe. And the fact that we have strategy in terms of the capex expenditures doesn't change the fact that one of our, let's say, main aspirations, I mean, maintaining a good rating, we'll stick to it. So we still want to be a unique utility across our peers, across our direct competitors in terms of the rating that is being granted to us. Wrapping up 2014 financials, annual general meeting approved our proposal of the profit distribution, so nearly 1.5 billion of zlotys is to be paid out to our shareholders. It's going to happen in October. So this is 78 groszy per share, which translates into dividend yield of approximately 5%, which is, in my opinion, very, very attractive, competitive these days. Now I'm coming back to a rationale that is behind our impairment tests. I think this is important to clarify why we decided to do this. I'd like to summarize this in at least four aspects. So first, already mentioned, this is a global fossil fuels squeeze. So the trend, we believe, is persisting in the medium term on all markets. What is crucial for many power markets is that the hard coal price, especially given its crucial position in the merit order, is going down. So deteriorating conditions have adverse impact on electricity prices, which leads to the whole merit order flattening. So margins are driven significantly down in the effect, especially for those assets that are placed closer to the left side of the merit order. So this is the first element, squeeze on the fossil fuel, global. Second element, European climate policy over the last months accelerated. Personally, I believe that this is an effect of coming summit on December in Paris on the climate issues. Very recently, even the President Obama from the United States called for the success of that summit. We will see. But anyway, when we look at the prices of the CO2 allowances, in the past 3 years, they maintained, roughly speaking, within the corridor between 6 and 8 euro per ton of the CO2. Very recently, they reached the ceiling of 8, and they're reaching the record levels, a little bit over the 8 euros. The recent regulations on the market stability reserve are probably one of the factors provoking that breach of the ceiling. But the fact is that those regulations has gone through, and what is the most affected, this is of course the conventional generation, and I'd like to put the greatest emphasis on less efficient carbon-intensive plants, which is lignite, obviously. Furthermore, the paradox, well-known the paradox of renewables development is that the more renewables capacity we have in the system, the more conventional capacity is required as a backup, which in a consequence leads to a systemic problem of low wholesale prices, because the market expects lower and lower prices coming from the close to zero variable cost sources. Thirdly, this is inefficient, in our opinion, market model for the electricity these days, because the competition on the market has been distorted because of different variety of the public interventions, accelerated growth of renewable capacities, also given the changing regulations in Poland, which favor dispersed generation, pushes the conventional generation out of the merit order. This is a very well-known effect. And limited operating time impacts the cash flow and therefore the profitability. Maybe on the Polish market that effect is not that visible as, for example, in the German market, but still we see that the future is more or less to be alike the Western countries, well developed or well equipped today with the renewables. That's why we have to take into consideration that the place on the merit order will be narrowing for the conventional power generation on the one hand, but on the second hand there will be still need to firm capacity supply to the system. The latest summer events, let me call it like that, I mean basically maybe not interruptions, but limitations of the power supply to the given customers shows the situation that the Polish electrical system suffers. What is another effect? What is to be influencing the market is also cross-border connections. They have currently limited impact on the Polish market, but we have to bear in mind that development of these connections will have an adverse impact on the volumes and the prices, especially when the Polish-Lithuanian connection is to be committed. It's, according to the PSE plans, is to be done by the end of this year. And assumingly, this should allow for some imports of energy from the Nordic markets. So current regulatory regimes, current regulatory developments are not supportive for the conventional power generation. Four aspect. Is there another elements of environmental protection than the CO2? I've mentioned the climate policy, which relates basically to the CO2 emission, but there is even more strict European environmental norms to be introduced, supposedly from 2021 to 2022. I mean, best available techniques, revised norms that relates to other pollutants than the CO2. They will require the further amendments in existing installations as well as the new built installations, as we experience in Turów, for example, basically leading to a higher capex expenditures at the same time, leaving the risk from such investments. Renewables, friendly law, of course, boosts investments within that sector. And don't get me wrong that I am against the renewables, because this is still an opportunity for us. I will tell you later about that a bit. But at the same time, we need to bear in mind that conventional generation is also required. That's why I'm coming back to my previous statement that we perceive the existing market model for the electricity as inefficient, and we will support any action and to change that in a more friendly for the conventional power generation, not because it is a conventional power generation, but because it is the only one of the few technologies that can deliver the firm capacity to the system. So the sector is currently under the quasi-capacity market regime. I mean especially operating reserve. And next year is the so-called cold reserve is coming into the force. But these are just, highlights, or no, how to say, just first signs of the more in-depth change of the market model. Basically, we need a capacity market model in order to finance the readiness to deliver the power to the system for those units who play the backup role. As always, we are not an island. We operate within some very concrete microeconomic ambience. The Polish economy hopefully keeps expanding at a relatively decent pace, I would say, which is well above 3% year on year. So the good news is that the growth still in Polish case requires more energy. This can be confirmed with the data on domestic electricity consumption, which is growing at the annual pace of about 2%. So we cannot complain as a company on the demand side of the electricity market. But meanwhile, we are concerned with the declining price of the hard coal. I'm coming back to that issue, because we can see that both Polish and international coal indices decreased substantially compared to the previous year's levels. Also, the climate policy has its say on the Polish market, increasing carbon allowances price. Carbon allowances prices are impacting the profitability of the electricity business. So, as an effect of all of those elements, the competition on the wholesale market is getting more fierce. When you look at the spot price in quarter 2 of the current year, it decreased by 50% year on year to the level of 155 zlotys on average. The same is with the next year forwards. They've been traded in second quarter of this year at the level averagely of 164 zlotys, which is 2% lower from the previous year's levels. So the prices are a little bit lower. What to do with that future that we see ahead of us? As I said, the management board had decided to review the strategy of the company published last year, in the middle of the last year. We know that market changes that we are facing in Poland and in the whole region require from us to review our strategy. Therefore, we believe that there is a must to conduct an in-depth analysis of our key aspirations and strategic activities with a goal to make them up to date. In particular, it's necessary to implement a profound restructuring of and a far-reaching efficiency improvement of the group, aiming at preserving ability to accomplish the ambitious investment program with reference to conventional generation. So we believe that ambitious investment program set in our strategy may be completed only when we focus on improved efficiency of our activities. having in mind the whole value chain, so every business line. This is not like that we are changing our main strategic aspirations, but we are putting the accents more on efficiency. Additionally, accelerated diversification of the generation portfolio is to become our strategic priority. Of course, taking into consideration the situation of the PGE and the situation of the whole Polish market. Due to envisaged rise in emission cost and stricter environmental requirements related to the climate policy, a continuous growth of the low-carbon activity is a must, with potential renewable initiatives like offshore farms. This is an example. That shows the direction that we believe we have to accelerate our diversification activity. PGE is also thoroughly analyzing its development plans with respect to the market situation and being focused on maximized efficiency both on CapEx and OpEx. Having said that, we will concentrate on efficiency. Of course, we will take into consideration, firstly, the operational aspects of our business, but we will not exclude from that review of our CapEx expenditures in terms of our investment plans. I'm not going to say that we will give up with the major investments that we declared under our strategy, but there is a variety of expenditures that we attributed to the modernizations, and we have to review it at the first step in order to, I'm not going to say minimize the capex, but because minimization is not a goal, but being as much efficient as possible in terms of each zloty that we plan to spend on our investment and modernization activities. We're also not forgetting about the other aspect that I already mentioned of our business environment. I've already said about the future shape of energy market in Poland. I'm going to use even more that position that as a chairman of the PGE, I'm also the chairman of the Polish Electricity Association. Last year we've established our permanent representation in Brussels, and the activity of it is developing very fast. We also plan to introduce the new structure of the whole electricity business representation functioning in order to be more influential on a regulatory level. And I mean it. M&A activities and divestments, this is also taken into consideration by us. Of course, when I say divestment, I mean in principle those elements of our business that are potentially exposed to the higher risk of the loss of profitability if still kept in our hands. Summing it up, our target expressed in the money is to find another 1 billion of expenditure cuts post-2016. Another, I mean, because we promised in our strategy we assumed under our strategy to have some costs in terms of expenditures for 1.5 billion zlotys, and then we will seek for another 1 billion of expenditures cuts within the horizon of our strategy. It should, give us comfort with our investment plan and profitability of our assets. But as I said, cost efficiency is a major condition to realize our strategic goals. So the fundamental task has already been undertaken, is scheduled, And as we informed in our communication, is to be completed in the forthcoming months, finally until the end of the current year. But of course, giving you information about the third quarter results, we will get you closer with, we'll update you with the more information on how we progress with our review of our strategy. Let me go to our routine job, which is about saying a little bit on our asset portfolio. So when you look at our generation portfolio, obviously its features are different. Let me start from lignite. Lignite assets are still most effective and profitable for us. However, they are to be mostly affected by the climate policy. We are aware of that. This is because of its relatively carbon-intensive nature on one hand, and on the other hand, on the fixed cost nature, relatively fixed cost nature. So newly built unit is, Turów, is high-end technology with the top efficiency, however, under further pressure from the new regulations. Hard coal assets, on the other hand, while being relatively more flexible in terms of costs, they benefit from structural oversupply of the thermal coal on the market, keeping still positive margins. Lower carbon intensity in that case is of significant importance as well. So therefore, Opole 2, our flagship project, profitability outlook is sustained. Renewables portfolio profitability is not threatened. Currently developed assets are to be completed in line with the adopted schedules. So by the end of this year, important milestone for the business development will be first auction under the new law, new regulations, which will set up a benchmark and outlook for the future. And so then we'll be able to give to ourselves more precise answers on how that business line may be developed in future. In terms of the constructions of our flagship projects, so Opole project has recently accelerated and currently is at the level of about 20% of advancement. So we are lifting up the cooling towers shell of unit number 5. Average daily progress of works is about 1.5 meters of a high. So we've just completed concreting foundation plate of boiler number 6. And that's one of the largest type of this work in Europe. Turów project is being realized. However, this is at initial stage of work, but works are in line with the schedule. However, as I mentioned, the stricter environmental requirements, best available techniques revision to be probably effective as of 2021, maybe 2022, led us to ask the contractor to redesign the project in order to comply with those stricter requirements. So in the result, the commissioning of Unit 11 was extended by 3 months compared to initially planned. Cogeneration project in Gorzów is at very advanced stage, so all main equipment is at site. Installation works are in progress. In terms of the modernizations of our conventional power, after a comprehensive refurbishment of units 11 and 12 in Bełchatów, we started working on units 9 and 10. In the coming year, we will finish the whole project of refurbishments of units 7 to 12 in Bełchatów, and we expect the increased efficiency of those modernized units as well as extended lifetime of them. So currently we are in a tendering process for the denitrification and desulfurization installations for Pomorzany and Bydgoszcz CHPs. These are our smaller projects, but very important from the local perspective. Thanks to those modernizations, both entities will remain in operation over the next several years. We have commissioned Karwice wind farm in July, expanding the wind capacity by 40 megawatts. Further projects, I mean Lotnisko, Resko 2 and Kisielice 2, are in line with the adopted schedule, and we expect that they are to be finalized by the end of this year. And that's everything from my side, as promised. I give the floor to Magda.
Thank you, Marek. Also, a warm welcome from myself to everyone who joined today's conference. As usual, I start by giving you some details on our half-year financials, followed with a deeper look into impairment test results, our key operational data for the quarter, and value drivers of EBITDA. Later, I will share some more light on our CapEx projects and CapEx advancement and general outlook for this fiscal. Our first half sales of 2015 amounted to 14.2 billion Polish zloty, which is flat versus last year. On a comparable basis, our second quarter sales rose by 5% and reached 6.6 billion, that is 7% on a half-year basis, and 13.9 billion of revenues, comparable revenues for the 6 months. That is primarily due to higher realized wholesale electricity prices. Reported sales in the corresponding period of last year benefited from a one-off adjustment to our long-term contract's final compensation estimate that was roughly 1 billion. Our recurring EBITDA grew double-digit in both second quarter and half-year, driven by higher electricity prices, improved retail margins, and better underlying operating performance. The second quarter increase in EBITDA was delivered largely by our generation and supply businesses. Those contributed by almost 200 million and 110 million respectively of growth. Reported EBITDA decline for the quarter is mainly attributable to an inflated previous year base, a one-off gain on sales I mentioned earlier, and CO2 provision released last year of 860 million Polish zloty. Higher interest rates on the government bonds led us to adjust our actuarial and land reclamation provisions and enabled to reduce costs by more than 200 million in the second quarter. Our first half underlying net result is down and in the red, amounting to 5.1 billion loss, reflecting impairment losses accrued in the second quarter of 2015. EPS excluding those charges is down by a quarter versus last year, mainly because of the decline in reported EBITDA I just discussed. Cash came strong this quarter, delivering 1.7 billion Polish zloty. That is more than twice versus last year's results, reflecting better working capital management and strong operating results. Our investments for the first half of 2015 grew by roughly 50% and reached 3.3 billion Polish zloty. We continue to deliver against the investment plan, as Marek already presented in his speech. More on specific projects will come in the next further slides. Our balance sheet remains solid. Our net debt as of end of June reached close to 500 million. Strong operating cash flow enabled us to keep debt levels to a minimum despite heavy investment outlays. In the second quarter, both our rating agencies, namely Fitch and Moody's, confirmed their view on our credit position. PGE remains the best rated utility in Poland, reflecting our leading market position. As we heard from Marek in the first part of today's presentation, deteriorating market conditions and demanding regulatory environment has put a significant pressure on our generation fleet. Having seen the downward trend of the current spot prices and future contracts, we followed the requirements of international accounting standards and ran impairment testing for each of our conventional generation cash-generating units. Tests performed are based on the projected discounted cash flows. Our tests took into account cash flows based on mid-term business plans, and beyond that horizon, we used analytical input of external independent research. Our key market assumptions include the wholesale electricity price growth by 20% until 2020, and a milder upward movement beyond that. Severe growth in CO2 prices, that is by roughly 2.5 times in 2020, and milder increases in the following decade. Flat hard coal prices until 2018, with an increase in the following 2 years and stable long-term outlook. The recoverable values of assets are derived over the estimated useful life. Weighted average cost of capital we used was at 7.26%, which is down from 7.63% we used in the previous year. The assumptions we used took into consideration expected changes to the Polish electricity market design. In particular, we factored in our cash flows support from a capacity mechanism that would remunerate plants securing supply of electricity to the system. We followed the mechanism established recently in the UK. Such legislation is still not yet present in Poland. However, we believe a reliable regulatory environment is required for the long term. Such view has also been expressed in the Poland's Energy Policy 2050 as shared by the Ministry of Economy. The document points out that long-term sustainability of the electricity supply may require additional capacity payments. Additionally, we accounted for free CO2 allowances. We also extended long-term gas cogeneration support, as we believe this most efficient electricity production will be supported in the long run. Impairment losses recognized in the second quarter amounted to 8.8 billion Polish zloty and affect our lignite operations in Turów and Bełchatów and less efficient hard coal-fired CHPs in Bydgoszcz and Kielce. Lack of impairment charge attributable to a power plant illustrates lower business risk of the more flexible, variable cost-based production supported by highly efficient new units in operation starting from 2018 and 2019. The recoverable value of existing generation facilities is sensitive to a number of assumptions. In particular, long-term movements of electricity prices up by 1% would lower our losses by 1 billion. However, an adverse movement would require an additional charge of 1.1 billion. Should the cost of capital go up by 0.5 percentage point, we would face an increase in provisions of roughly 1.4 billion, a drop of 0.9 billion if the move is in opposite direction. An additional charge of roughly 5 billion could be incurred if no long-term solution is established to provide for the capacity in the market. Let us now move to the next slides that show some more information on the group's operations. Total generation output for the quarter is flat versus last year, with 13.1 terawatt-hours produced. During the second quarter, the performance was largely driven by high availability of our lignite fleet. With the modernized Unit 11 in Bełchatów back in operations, we delivered an output higher by 3% year-on-year. Hard coal-fired power plants output was down by 17%, as our Opole and Dolna Odra units have been less favorably used by the TSO, with roughly 4,000 hours more time put in the reserve. Again, with cogeneration support present for the full quarter, we see higher output at gas-fired CHPs. Weather conditions supported our wind generation, that is up by 14% with 0.16 terawatt-hours produced. Hydro conditions have been less favorable compared to both the previous quarter and the corresponding quarter of last year. Pump storage generation suffered a drop in output, reflecting lower demand from the TSO. Our generation and distribution results reflect good and improving underlying operating performance. High availability of the fleet in the first half of 2015 allowed to benefit from favorable energy markets. Our lignite fleet delivered more than 4,000 hours of operating time. Load factors for hard coal-fired units are down compared to last year. That is driven, as mentioned, by the TSO's demand. CHP's load factors increased, driven by reinstated cogeneration support, and wind asset performance reflects improved weather conditions. Distribution performance has been improving for the last quarters, with network losses reaching a record low slightly above 6% in June 2015. As with previous quarters, we continue to deliver strong results when it comes to reliability of supply, with SAIDI and connection times down by double digits in the first half of 2015. Now let us take a deeper look in the main earning drivers. As I mentioned earlier, Group's recurring EBITDA for the last quarter, reached 1.7 billion Polish zloty, which is up by 16% versus last year. This increase is primarily attributable to increased power prices. Average realized wholesale electricity price for the quarter came at 174 zloty per megawatt hour, up by 11 zloty versus last year. Lower production volumes at our hard coal-fired plants led to lower costs of dead fossil fuels. The volume effect was also accompanied by lower prices, down by mid-single digit, and allowed to save 89 million compared to last year. CO2 proves to become a growing burden to our earnings. Increased CO2 prices charged our P&L with additional 22 million. Our generation units are also receiving lower CO2 allowances relative to previous years, which penalizes our last quarter's earnings with additional 10 million. Lower cost of renewables support by 33 million reflects lower prices of green certificates. Earnings for wind and biomass generation dropped, but were largely offset with savings at our retail branch. Cogeneration support remains to hamper our group's results, chiefly because higher retail costs was only partially offset with additional generation margins. Distribution returns improved by 58 million, largely due to higher demand and increasing customer base. Our first half investments of 3.3 billion were 50% above the prior year's figure. Our development projects, namely Opole and new wind capacity, were our key focus areas, consuming more than 1.2 billion of our capex pie. We deliver against our wind project priorities, with Karwica wind farm already in operations, as Marek mentioned, and remaining projects, Lotnisko Resko and Kisielica, adding capacity until year-end. We invested more than 300 million in the comprehensive modernization of our Bełchatów fleet. Distribution capex came at close to 700 million, with a fair split of funds towards modernizations and network expansion. As to full year's result for 2015, our outlook remains stable and consistent with the first half results. We expect to deliver strong recurring growth with our generation business, driven by higher wholesale price of electricity. We estimate the full year long-term contracts compensation to support our earnings in the range of 500 to 600 million Polish zloty. Our renewables business is expected to deliver flat bottom line, as favorable weather conditions allow for higher output, offsetting lower green certificate prices. No significant changes to our distribution business results are expected. We maintain our outlook flat. Supply, in particular retail sales, get some relief from lower cost of renewables support and shall deliver higher results versus last year. We are on track to deliver a record high capex expenditure, as our key growth projects require increasing investment outlay. That concludes my presentation for the first half of 2015. This quarter operations and financial performance came strong. That allows for headroom for the future. A solid balance sheet and strong cash flow will be an undisputed caution in the view of weak power prices and deteriorating market conditions going forward. I suggest we move to the Q&A session, if it's fine with you, Kuba.
That's very fine with me. I guess that will be even more fine with you in the room. For the sake of us answering the questions and for the intended viewers to make it easier for them to follow, could you please limit your questions at once, because it's difficult to address it at once later on. Obviously, internet audience will be ready. We will be ready to address their questions if they are sent via email. Please, the floor is yours.
Paweł Puchalski, Demokratski PZWK. You are revising your strategy. Does it mean your EBITDA guidance is under revision or suspended as well?
As presented by Marek in his presentation and his speech, we are reviewing the key areas of our strategy. That includes the efficiency gains we potentially could run across the whole value chain. That includes the strategic priorities and the following plans for modernizations and investments. That also includes the mix of our energy production and diversification of production assets portfolio. We will come with a comprehensive message to the market, what it means to our financial indicators and financial aspirations, but as a general message on the total strategy review that and as such, we would like to avoid giving you any specific guidance as of today, as it requires a very comprehensive review of our projections and strategic priorities for the future.
May I have one more? The question would be, where did you take your €20 per CO2 certificate price from? Because your model seems very vulnerable to CO2 pricing. I've calculated on my own, that's not linear, I know I'm wrong, but I've calculated that if you apply 27, posing difficult question. If you applied 27 euro per ton, you would have to write down your entire lignite assets. So where comes 20 in 2020 from?
The group has gotten the group PGE, specifically strategy department, has got an analytics team that runs analysis of the market and potential scenarios for further market developments. But it is not only the internal assumptions that we used for our projections, but we also confronted that with the projections delivered by our independent advisor, namely that was ARE, and we compared the assumptions prepared internally with those that we acquired externally, and both those movements that are expected in the market show a significant growth of CO2 cost, reaching roughly €20 per ton in 2020. Sorry, can we help it out with technical issues?
Krzysztof Kuliszewski, Trigon. My first question is about right of assumptions. It says
The estimated starting point is next year's contracts power prices. Yeah.
And the other question is, the company had its dividend payout of 40%, just as its net debt turned positive. Should we expect the 40% payout as long as net debt is positive?
As we said, we will analyze the economic situation of the company and all the environment that we operate within, and then make the decision upon the concrete numbers in terms of the dividend payout. But believe me, we want to pay the dividend. We want to pay dividend as we promised in our strategy, and we will stick to that policy firmly. That's it. So you're asking me about. You're asking me a question that I cannot answer today. Just a question about the future policy, concrete numbers, right? So we are not, so the 40% is 50% are, from today's perspective, the same probable, I could say, you know. So this is what one thing should be sure, should be taken as a sure by you, right? That, you know, we decided to change our policy in order to, you know, in order to have the dividend not to be impacted by a kind of but impairments, just to pay the dividend for us shareholders, because they deserve to be paid the dividend. That's obvious, right?
So maybe a third question. You're right to cost the CHP input goes to zero. At the same time, recognizing it. Shouldn't it be withheld for now?
If we still are convinced that after modernizing the CHP in Bydgoszcz we can make money, we are able to make money, why to you know, stop that investment? Do I understand correctly the nature of the question, maybe? Was you suggesting that I should stop, you know, the modernization expenditures, right? The money that I spent for the modernizing the CHP in Bydgoszcz?
Right, so it's already been started. So the modernization is ongoing, okay? So before you take the right of ongoing.
Yes, but the future tariff policy, we believe this is the regulated market under the quasi, I could say, close to market regime, because if you take into consideration how the district heating tariffs are constructed, then you will see that you know, there are not too strict rules as those, for example, that the distribution of electricity has to respect as a reference price that below which we have to, you know, we have to maintain in case we don't want to have our tariff approved thoroughly by the regulator. So what I mean that the future incomes from the district heating market in Bydgoszcz would have to, you know, respond to the prospect of having this asset profitable.
Hello, Piotr Zięciałowski from Citibank. I have a question regarding slide 13. Given that Dolna Odra power plant is worth zero, can you please explain to us why similar power plant Ostrołęka could be worth something based on the book value and the international accounting standards, and your plant is worth zero? So is it just a management discrepancy in how they view the market? And given that you think it's worth zero, why don't you give it away for free to New Kompania Węglowa the same way as your competitor does, as you expect no cash flow from this asset? And second question on CO2. Inherently, you take a risk on CO2, and assuming you think it's worth 20, why don't you buy a lot of it for the future years? It's totally inconsistent. If you can avoid the write-down by spending money today, investing in it, it's a lot better investment than any other IRR you can get on any of your projects.
Let me first start with the book value of the asset, and then we will follow up on the rest of the question. We are obviously not in a position to comment on the book value of assets of our competitors. We reviewed and revised the book value of Dolna Odra back in 2012, when with the year-end close we decided to incur the impairment losses of the asset. That was thoroughly analyzed and audited by our external auditor, and independent audit opinion was issued. We annually review the recoverable amount of the recoverable value of Dolna Odra plant, and we see no judgment, no justification for a reversal of that impairment loss we took in 2012. That would mean that we report the value, the net book value of the asset as zero, as it is reported on slide 13 and in our financial statements.
Well, in terms of the fund you mentioned.
And can you please then explain about the Dolna? Why don't you give it away, sell it down, or shut it down, given it's worth zero? And there is no indications to revise the asset up.
We said it a couple of times already. This is a kind of a regulatory asset, and today maybe you don't know, maybe you do not know it yet, but there is a complex revision led by the transmission system operator, but helped by our society, in order to prepare a new model for so-called ancillary services model, right? We promised under our strategy from the last year that we will try to profit on the location of such a unit like Dolna Odra, sorry, because the location within the system provokes, right, that regulatory nature of it. But it requires the change of the ancillary service model offered by the TSO, and that work is in progress. That's why we decided not to do what you suggest with that unit. We still believe that the regulatory character, regulatory feature of that asset can be profitable for us in the future. That's it. Okay. But I will not comment, sorry, for what which entity proposed, because this deal is not done yet, proposed to this or that fund. That's not my job to comment on the decisions on the other management boards.
And can you please tell us why, given that you see 150% upside in the CO2 price, you're not buying ahead a lot of it? I mean, clearly, you know, the explanation that external consultant gave you 20 euro per ton figure is not satisfactory. We would need to see, you know, what's the excess deficits of CO2 you expect, what's the shape of the next phase of ETS you expect, and so on. But clearly, you're taking a big write-down saying there is no value in this asset, and you can avoid it by buying a lot of CO2, and you're not doing it at the same time.
Let me remind everyone that PGE has got and maintained a hedging strategy for CO2, hedging volumes of emissions with volumes of electricity sold. And that is the current policy that we run. That is also the current policy that that drives our procurement decisions when it comes to CO2.
Thank you very much.
Actually, we have 4 questions in total, but 2 from each of the internet viewers. First, from Fred Barazzi from Goldman Sachs. Can you provide an update on discussion for the new regulatory period for distribution? The first. And the second, can you help us to understand the possible impact of the impairment on future depreciation charges?
I will start with future depreciation charges as it's an easy one. Obviously, the lower net book value of assets would mean lower depreciation charges for the future periods. The expected economic useful life of the assets have not been revised. So you should expect on the same useful life of the asset, lower charges. And the new distribution model, I would suggest Marek addresses the question.
It's a better question to the regulator. However, we are in constant contact with the regulator. I think that just my personal judgment that new so-called quality-based regulation system probably will be a little bit delayed. It's just my opinion, or softened to the degree that the new regulatory model, if applied, is to be closer to the existing distribution regulation model. So we do not expect any major changes. So this is a recent development that I think, transmit to you. But this is just my personal judgment and optics on it. But the talks with the regulator are good. So that's why I'm responding rather positively on the future around that segment. Right? But finally, the decision belongs to the regulator. We'll see.
We have 2 more questions from Igor Kozmin from Morgan Stanley. First, have you already assessed any specific areas and assets of potential divestments? And secondly, how frequently is PGE to run impairment tests?
Well, in terms of divestments, we will concentrate in principle on so-called non-core business areas. We already informed the market directly or indirectly about those areas. We have a telecom, for example, company that is not within our core business area. That's one of the elements. Of course, we will also analyze any other business lines or sub-lines of our business, like, for example, CHP. But this is very initial statement, and you shouldn't draw any concrete conclusions from that. We will analyze everything what is not our core business, and that list is to be subject for potential divestment actions, if necessary, of course, because profitability of the different subsegments of our business lines might look differently. So depending on the judgment, on the result of our analysis, we will make the decisions. But in principle, non-core areas.
And when it comes to impairment testing, we simply follow the requirements of international accounting standards. Those requirements mean that assets are tested for impairment at least annually, or with any reporting period if there is an external indication of a possible impairment. This is exactly what happened in the second quarter of 2015. Should the market conditions remain as they are, we will not be testing for impairment with the next quarter. We will perform annual impairment tests as a regular year-end close routine.
We have no more questions from outside of the room. We have one follow-up from the room.
My question is on price of thermal coal. In your assumption, you suggest an increase in 2019-20, and I would love to understand what you expect to happen in 2019. Is it Upper Silesian volumes collapsing or Chinese economy rebounding? Because you specifically point to year 2019.
As Marek mentioned in his presentation, we see a structural oversupply in the Polish market that we expect to gradually decrease in the coming years, causing the prices of hard coal up. That is a mild growth in 2018 and 19. We are not talking large growths here. We believe the global pressure on the commodity prices, including hard coal, will remain. However, we believe that the local structural issues will get solved within the coming years.
But if you assume there is a further pressure on global commodities, why you expect flat thermal coal price until 2018? Then you should expect steady or strong decline, annual decline until 2018.
Remember, we are talking about local hard coal prices here that we use for our assumptions, as hard coal is sourced domestically for our power plants.
I understand you are not considering buying at Rotterdam price.
Local supplies for our hard coal power plants, hard coal-fired power plants, and that is also the basis for our assumptions in impairment testing.
And besides, by 2018, we have a long-term contract.
Even longer.
Even longer, right, for 5 and 6.
It expires in 2018, or you have to call it off?
I have two types of a contract with our domestic suppliers. The existing one is 4-year lasting contract that expires 2017, if I'm not wrong. We have to renew. This is just a regular routine business that we do with our partners. Beside of that, we have a new contract, 20-year contract for Opole 5 and 6, which is to be commissioned in 2018. Okay. So far we based on our domestic suppliers, and there is no change in our policy. You know, we were built. I mean, our generation fleet were built concretely, taking into consideration the physical features of the Polish coal, and of course they can be modernized, but it has its consequences in the capex expenditures. That's why this is not an
overnight exercise.
Or exactly, this is not an overnight exercise. That's it.
Thank you for follow-up question. Can you imagine the situation in which hard coal competes with lignite in Poland and merit order is mixed up? Because the one way which you can restore the coal demand is lower production from lignite. I can see that ZEPAK, your competitor, can be squeezed. We hear about the prices of coal being sold on the spot at 5-7 zloty per gigajoule. That's around your production cost. So, and also within Kompania Węglowa, we see mines that give space to the WOS assets to let them produce. Can this scenario also affect you, that you will, for the technical, economical reasons, restrict the volumes of lignite power production?
Well, the very low spot prices of the hard coal, I don't believe that they can be kept even in the medium term because of the cost of extraction of the hard coal in Poland. Hard coal in Poland comes from the level 1,000 meter plus, right? Contrary to the other points in the globe where sometimes it is even not extracted but just taken from the ground, or from very shallow depth. So that's why we took rather conservative approach, I think, in terms of the price formation of the domestic coal, but taking into consideration cost of the extraction. Yes, of course, that coal market is to be, in our belief, under the constant pressure from the external world and the global situation, because the prices of the hard coal, this is not a matter only of the cost of its extraction, but also of the situation of the, for example, crude oil, right? The primary source of the fuel around the world. So if the crude oil is going down, then respectively all the other types of the fossil fuels are going down. That's what we are observing today. Hopefully we control our lignite mines, and as we declared, we will concentrate on cost efficiency also within that segment in order to stay competitive. What is dangerous, this is relatively higher carbon intensive technology, right? So we emit more CO2 per each unit of production compared to the hard coal fueled power plants, and that's the challenge for us. That's why we have to concentrate on the cost element. So far, in terms of the Bełchatów, we are successful. Yeah, we have to do something about our Turów, but this is visible about the latest impairment test that is under strict review from us.
Okay, thank you very much.
Thank you very much for coming to talk to us, to ask your questions. Thank you very much for the internet viewers. We'll see you in November after Q3 results. Thank you.
You.